What are FVG? FVG is an expansion. You can explain price expansion as a single continuous process, where one action triggers a chain reaction that turns into an avalanche. The price moves in a certain direction and approaches an area where a large trailing stop is located. A trailing stop is essentially an automatic exit order, and when price touches it, the system must execute the opposite action of the original position. A large long position will close through selling. A large short position will close through buying. The trailing stop is triggered. The position closes. Because this is a large position, the closing order creates a sharp push in the opposite direction. This push moves the price into zones where more trailing stops, regular stop losses, or leveraged liquidations are waiting. As price continues moving, it triggers more stops and more liquidations. Each stop out is another opposite direction order with significant weight, feeding the move that just started. The system enters a state where market energy is no longer coming from traders voluntarily placing new orders, but from forced actions being triggered automatically. This is the turning point where a small move caused by one trailing stop becomes a vertical-like flow, a move that reacts but no longer balances itself. Every stop that is triggered acts as fuel, accelerating the move even further. At a certain point, what looked like a normal move becomes an expansion, a sharp and accelerating price burst. This is the avalanche. Not because of one large seller or one large buyer, but because of a sequence of automatic actions, each one ensuring the next will be triggered shortly after. Once the expansion completes and the market finally exhausts itself, price often snaps back into the previous range. This is where the corrective phase begins. As price lifts off the expansion's low, it approaches the zone where early trend followers entered their short positions. These traders expected a steady continuation to the downside long before the expansion occurred. Instead, the expansion drove price so fast and so far that their positions turned negative almost instantly. When the market begins to correct upward and returns toward their entry area, something important happens. These trapped short sellers experience a mix of fear and relief. Fear that the expansion overshot its real value and the move may fully reverse. And relief that price is finally giving them a chance to exit at break even rather than take a loss. As price revisits their entry levels, a wave of break-even exits is triggered. Every short closing out becomes forced buying. And as these shorts unwind, the accumulated buy pressure lifts the market higher, feeding the early stages of the correction. This means the correction does not begin with motivated buyers, it begins with forced buyers. Their exits spark the initial upward push, which is then reinforced by mean reversion traders and automated systems that detect exhaustion. The result is a clean structure. A vertical expansion fueled by stop cascades. A stall. A return into the cluster of trapped traders. And a corrective rally powered first by capitulation, then by fresh participation.